By almost any metric that you look at, the market is extremely highly valued today. This is just a look at the S&P 500's price to earnings multiple from multiple.com. And you can see that the PE multiple is about 30. The only time that we were above that we weren't already in a recession, so where the E part of the price to earnings multiple had already started to drop, was in the dot-com bubble late in the 1990s. The other times where we were above this multiple was in the middle of the dot-com bubble, the great financial crisis, and then shortly in 2020. So it's hard to argue that the market isn't probably pretty overvalued today. So that means an investor should be looking for value stocks. Where is there a phenomenal business that's just simply mispriced by the market? I'm going to go through 3 that I think are phenomenal buys today. I own them all in the asymmetric portfolio. And if you want to know everything that I buy for that portfolio, check out Asymmetric Investing, my newsletter, link on the screen and a link in the show notes. I buy stocks every single month. I'm going to be doing that again at the beginning of September when the market opens on September 2nd. It's a very simple portfolio, just buying phenomenal companies every single month, but I'm buying companies that can compound and potentially become 10x returns over the next 10 years. That's what asymmetric investing is all about. So if you're interested in more from me, check out that newsletter, asymmetric-investing.com. And the data I'm going to be using today to show you exactly how cheap these stocks are is from fiscal.ai. If you go to fiscal.ai/ASYM, you can check out their platform for 2 weeks for free. If you like what you see, you can get 15% off. I'm going to be showing the enterprise version in this video today, 20 years of data, and they have phenomenal key performance indicators or KPIs. It's going to tell you everything that's driving a business. This is something I use constantly. You're going to see the platform and the charts that I use here. I use them all the time in the newsletter and also on social media as well. So this is something that I am in constantly when I'm looking for new investment ideas. And also when I want to dig deeper into what are insiders doing? Are they buying or are they selling? What are the latest SEC filings? What do investor presentations look like? All of that is on the Fiscal AI platform. So check that out. This is a product that I pay for myself. So I'm putting my money where my mouth is. But let's get to the first stock that I think is extremely undervalued today, and that is Lyft. If you've watched my videos before, you may have seen me talk about Lyft. I think this was one of my top stocks for 2025. It is now beating the market 19% to about 10%. But look at what's happened over the past 6 months. Shares are up 28%. The market's sentiment around Lyft is really starting to turn, and that's because the business continues to do really well and the stock is very, very undervalued. Let's go to the business fundamentals because that's the first thing that is most important for investors to look at. These are the company's numbers over the last 4 years. So you can see that the margins are really improving. That's the blue column. Down here, they are now net income positive, also free cash flow positive. Net income, remember, includes non-cash charges for things like stock-based compensation. Growth rate, well, 20% over the past year. Now, this growth rate is going to ebb and flow quarter to quarter, but I think what you're generally seeing is that people are looking for more and more rides. And there's reason to think the Lyft is going to be able to juice that growth rate in the future. They added an acquisition called Free Now in Europe recently. That was a really cost-effective acquisition. Gets them more into the taxi market. It's not the direct-to-consumer market like the way that Lyft is in the US, but it also opens the door to autonomy. So think about that. I'm going to get to that in just a second. But let's look at some of the factors that are driving the business. The pink line that you see here is the active number of riders. This is growing at about 10% on a compound annual growth rate. 26 million active riders. A lot of opportunity to grow there. Yes, Uber is the number one player, but what you're getting here is a company that's trading for about a quarter the value of Uber, and they're still having almost the same growth rate as Uber. Blue is the number of rides that they're executing. So that's growing even faster. So the users that they do have on the platform are using it even more. That compound annual growth rate over the past 4 years, 17.1%. Gross bookings is the other thing that I want to show here. Let's just hide the other two. Gross bookings is going to be an indication of the amount of money that's going through the Lyft system. So Lyft does not generate revenue for every dollar that you spend on Lyft. If you go take a ride on Lyft and you spend $10 on the ride, Lyft generates about $2 to $2.50 of that in revenue. But the booking, that $10, is what this number indicates. So $17 billion in gross bookings over the past 12 months. And that's the number that continues to just steadily grow quarter after quarter. So we're talking about a company that's growing double digits, is now profitable, generating positive free cash flow. And the price to earnings multiple, look at this on a forward basis, just 12.7. Price to free cash flow is just 8.6. Not only is the price to earnings multiple, price to free cash flow multiple very low, but the balance sheet is really solid as well. You can see, let's change this to the quarterly numbers. because they recently paid off some of their debt. So $526 million worth of debt, $1.8 billion worth of cash. So more than $1 billion in net cash on the balance sheet. And the market cap today, just $6.6 billion. So you're really paying over about $5.5 billion for Lyft's business. That makes that multiple even lower when you pull out cash. So just a phenomenal value. And the real reason to think that this could be a 10x stock is the growth potential. Lyft is leaning into autonomous driving with a number of different partnerships. I'll highlight just a couple of those in just a second, but this is the way the company looks at the value chain. So you're going to have self-driving technology, the company that actually makes the vehicle, and there's going to be, somebody's got to own that vehicle. That's going to be asset ownership and financing. Somebody's got to manage the vehicle. Who's going to charge it? Who's going to clean it? And then there's going to be the mobility and marketplace platform and the rider demand and experience. So this is where Lyft lives right now. They also have a company that is called FlexDrive. This is really just a company that operates vehicles right now. It's a little bit like a rental business. So if you want to go drive for Lyft and say, you know what, I don't actually have a car, they will say, okay, you can rent a car from us and we'll actually manage that vehicle. So they're going to turn that into a fleet management business for autonomous vehicles. Those vehicles are going to be coming from a number of different companies. They have a partnership with Volkswagen. They have a partnership with Mobileye. So Mobileye-enabled vehicles are going to be able to be put on the Lyft platform. They're going to be known as Lyft Ready when they come off the line. So maybe you buy a vehicle that has Mobileye Drive. That's going to be their fully autonomous platform. And you want to put it on Lyft. You could do that. You could also have a business that owns 10, 20, 30 vehicles in a city, and you just put them on the Lyft platform, and Lyft will even manage that through FlexDrive. So that's the vision for that business. They also announced a partnership with Baidu in Europe. Remember I mentioned the Free Now acquisition that gets them into the fleet business, like taxi business in Europe. Well, now just replace taxis. That's going to be a group of taxis instead of individual drivers. It's going to be a group of taxis that are operating together. Now just replace that with autonomous vehicles, fleets of vehicles. That's why the Free Now acquisition makes so much sense for them, because they don't need to deal with individual drivers because they're dealing with fleets of taxis. Now, as they move to autonomy, they're going to be dealing with fleets of autonomous vehicles. I think this makes a ton of sense. Bringing Baidu, also Mobileye and Volkswagen are operating in Europe already. So those are probably ready-made partnerships. I think this is the kind of company that's very overlooked by the market. One of the multiples to look at here is enterprise value to sales, just 0.9 right now. Uber's enterprise value to sales is 4.2. I own both of these stocks, but the one that absolutely is the cheapest is Lyft. And I think they actually may have a easier path to autonomy because they can essentially burn the boats. They can say, you know what, in this city, we are not going to do individual drivers anymore. We're going to go fully autonomous. They could bring a ton of supply to the market. That would ultimately be really disruptive. And they could probably do that easier than Uber. In a place like Europe, they may just go straight to autonomy and not have those individual driver relationships with the Lyft brand. So this is one of my top stocks. I continue to add shares month after month and love doing so at this price. Stock number 2 is MGM Resorts. Again, this has been a stock that has been extremely cheap for a very long time. They have been buying back a ton of shares. I will get to that, but let's look at the overall numbers. A little under $11 billion market cap. This enterprise value, a little bit misleading because this includes the leases, the long-term leases that they have for their properties that they've sold to Vici Properties in particular. This is basically REITs that over the last decade have acquired most of the physical land in Las Vegas and all around the US. And then you sign a long-term lease with those companies. That shows up in debt. But the price earnings multiple is just 22. That's despite the fact that you do have non-cash costs coming out of earnings, like depreciation. Forward basis is about 16. I think the stock is even cheaper than that when you look at their cash flow. Well, let's go to some of the operating numbers. There are 3 places where you're going to want to look at the operating trends for MGM Resorts. That is going to be Las Vegas in gold. Blue is the regional casinos, and then orange is MGM China. That is their Macau operations. So you can see that Las Vegas is doing extremely well. This is better than Las Vegas has ever done. When they came back from the pandemic, they actually hit new records and have not really gone anywhere since then. But here's what the market is worried about. This revenue number in Las Vegas is starting to go down just a little. Not a lot, just a little, a couple of percentage points. So the market is saying, you know what, if we go into a recession, if consumers are actually stretched right now and they're going to start pulling back, they're going to probably start pulling back on things like trips to Las Vegas. That could mean that revenue could continue to decline. But these resorts are still extremely profitable. Not quite as profitable as they were a couple of years ago, 3.3 billion in adjusted EBITDA as of the March 2023 quarter. All these numbers are trailing 12 months. Over the past year, $3 billion in adjusted EBITDA coming from Las Vegas. Remember, they're not building new casinos in Las Vegas, not a high investment area. This is just a cash flow machine. So this is cash that continues to come from Las Vegas, $3 billion without a ton of capital investment that needs to go back into that business. I think it's $500 or $600 million per year that they continue to reinvest in that business, updating rooms and things like that. But this is just a cash flow business. And that is what I love about MGM Resorts right now. Not a high investment business, a very high cash flow business. Regional operations, you can say the exact same thing. Numbers declining just slightly because, again, consumers are starting to pull back a little bit. Not quite the gaga days it was in 2023, but still doing really well, over $1 billion in adjusted EBITDA. Where there is growth, and this has continued over the past year or so, is in China. This is Macau, actually. But $1 billion in adjusted EBITDA there. They own a little over 50% of that that business, and they just get a dividend each year from that business. Again, not a ton of investment going into new casinos because this is a limited supply market. This is the biggest gaming market in the world. And MGM Resorts is one of only 6 players there, going to continue to generate a ton of cash flow. So these are the core operations. And what are you paying for those core operations? Well, you can see in their financials, they have about $6.2 billion in debt total. $2.8 billion of that is in MGM China. So only $3.4 billion of that is domestic. Now, with this great value, with this great cash flow, management has been buying back stock. I pulled this chart all the way back to 2003. This is how far the data goes back on Fiscal AI. But you can see starting in about 2018, they started buying back shares of stock. This is when they started selling a lot of those properties to REITs. So that was one of the things they did with the cash, was just bought back stock. But look at what has happened to the number of shares outstanding. 580 million shares outstanding in the September 2017 quarter. Now just 292 million. So with this excess cash, they're just buying back stock quarter after quarter, about 15% of shares outstanding being retired each year on an annualized basis right now. So that's the value side, but I have not even gotten to the 2 most exciting growth opportunities for MGM Resorts. The first is their online gaming business. BetMGM is now EBITDA positive, so they are starting to make money from BetMGM. That's a 50-50 partnership with Entain operating in the US. They also own the BetMGM name in international markets. That's a business, still continues to be an investment business, but they're not investing a lot more in that now from a cash perspective. They're expecting that to be profitable. These businesses combined could be generating $500 million plus in adjusted EBITDA or cash flow in the next couple of years on top of that. This is their next major casino. This is MGM Japan. This is a $10 billion casino. They're going to own, it's 44%. They're continuing to invest in this, but they're doing that with the cash flow that's coming from the business. That's one of the reasons those buybacks have gone down just a little bit over the last year or so, is they need to invest in MGM Japan. And this is going to be a casino and resort that could generate $2 billion in adjusted EBITDA each year when it finally opens up. So about $1 billion that could come just to MGM Resorts. You add all of this up, and I think MGM will continue to buy back shares at this extremely cheap price. Management has said basically when you back out their stake in their online gaming business and in their China business, the core business, the US business basically is trading for about 3.5 times adjusted EBITDA, or the cash that it's generating. So when it's that cheap, you might as well just buy back stock. That's what management is doing while they're still investing in online gaming, continues to grow, continues to become more profitable. And the really exciting thing, in 2030, MGM Japan is going to open up. When it does, that could be the most profitable building in the world. I don't know when the market is going to start caring about that massive new addition, but it will sometime over the next 5 years. And when it does, I'm going to be holding shares in the asymmetric portfolio. Stock number 3 is Alphabet, and I'm not going to make this complicated. Alphabet is one of the best companies in the world. The market still thinks that search could be disrupted. I don't think there are any signs that search is being disrupted right now. In fact, search continues to grow and it continues to get more and more profitable. AI overviews, AI mode have been really folded in nicely. And now we have seen over the past, just even the past few months, that Gemini and Google's DeepMind models are the best AI models in the world, particularly for images and for video. And you look at the future of artificial intelligence, Yes, things like LLMs and text are going to be important, but images and video are going to be extremely important for things like advertising, and that's where Alphabet makes its money. So just a high level overview, $2.6 trillion market cap today. Price to earnings multiple is only about 21, 22, depending on if you're looking at a trailing basis or a forward basis. So not a real expensive stock. And the compound annual growth rate, if we look back over the last 5 years, compound annual growth rate, 17.5%. Now, this may break the narrative of the market, but the growth rate for Alphabet has actually increased since the ChatGPT moment. So the moment where Alphabet was supposed to be disrupted by OpenAI, by ChatGPT, their growth rate has actually increased since then, 14% in the most recent quarter. These are all quarterly numbers now. And even in the past couple of quarters, that growth rate has picked up. That is in large part because of more growth or higher growth in Google Cloud. Google Cloud grew 32% last quarter and is continuing to improve margins and get more and more profitable quarter after quarter. The great thing about artificial intelligence for Alphabet is they have a ton of ways to distribute this to customers. So they have a profitable core business and they can use their AI developments, make those improvements in Android, make those improvements in search, in YouTube, Gmail, Google Docs, all ways that they're going to be able to distribute all of these solutions. This is going to be much more of a vertically integrated company going forward. Hasn't always been the case for Alphabet. They have been much more of a horizontal services company. So they want to be on every device. They want to be doing everything for everybody, no matter what's the hardware you're using, what application you're using. But in the future, it may be the case where you want to be in the Alphabet ecosystem. It may make Android devices more attractive. If you're integrating the cloud and Google Cloud, that is the leading cloud right now. We've seen them partner with Meta. We've seen them partner with OpenAI. These are companies that should be competitors, but they're choosing Google Cloud clearly because it is the best solution for their businesses. So let's not make this overly complicated. Alphabet is one of the best businesses today. We don't see a lot of evidence that it's being disrupted by ChatGPT or by artificial intelligence. In fact, I think that we are seeing tailwinds, and there will be more and more profitability to come as they optimize those AI solutions in the future. They have the business model for AI. So Alphabet, one of the companies I continue to add in the asymmetric portfolio. It's one of the biggest positions that I have. I'm happy to have it there because it is not only a growth stock, it is a phenomenal value as well. So the three stocks that I went over today, Lyft, MGM Resorts, and Alphabet. Let me know which one of those three stocks you think is the best value in the market today. And like I said, check out Asymmetric Investing, my newsletter, if you haven't already. There's a free option to that, and then the premium version gets you access to the asymmetric portfolio and every single stock that I buy every month. So it'd be great to have you as part of that community. And if you like what you see from Fiscal AI, check out fiscal.ai/ASYM. Thanks for watching, everybody. See you here next time.